Happy Wednesday. Welcome back to another week of the Educated Homebuyer Live with myself and Mr. Josh Lewis, our mortgage expert. He's putting on chapstick as we're getting ready, as if somebody's
gums are going to be flapping. We got to get ready for it.
See if he's going to notice. The big news this week, interest rates. Interest rates are, hit a 4-month low, starting to trend in the right direction. We're going to talk about them a little bit more this evening and where they're headed, while we update you on the economy, answer your mortgage and real estate related questions. But while we're doing that, do us a favor, let us know where you're watching from, and also start putting your questions in the chat so that we can flow right out of this, right into your questions to help you get the information you're looking for. So Josh, what's happened over the last week in your world?
It's near month end on a short month like February, and we had, lest you guys think, we have a very well-designed process and well-oiled machine, and things 99% of the time go very smoothly, but they do not in mortgage world always go smoothly. So 2 unique situations this week. We found out a property about 2 days before closing was not a single-family residence. It was a planned unit development, which is a distinction with almost without a difference, especially when there's no HOA on this. But been chasing our tail the last 2 days on that, and on another one that ended up being 3 parcels, and only 1 parcel was included on the purchase agreement. So,
Josh, I feel your pain. Real estate's not always easy. I've got one deal right now that's breezing through in LA. Viewer of the show, appreciate him watching and trusting us to help. It's been the smoothest deal ever. Got somebody else that couple of days before closing, HOA sent us a notice to resolve an issue in the property, and now we're delayed. And for how long, I do not know. And we're working through it. It's not dead, but it's not always quite as easy as people want to make it. AI cannot solve this problem. How's that? AI could not take Jeb's job today with the problems that I have in real estate. So anyhow, let's move along. As I asked, if you don't mind, let us know where you're watching from. Start putting your questions in the chat, Josh. And as we do that, we'll kind of dive into what seems to be the favorite part of the show I've found out, and that is the charts. The charts. So this week, inventory did increase a little bit, sitting at 640,000 unsold single-family homes on the market. That's an increase of 28.7% more than last year. The number 1 state, Josh, California, leads the country in inventory growth over the last year, with 45% more homes on the market. Now, as we always talk about real estate being local, not all that's translating into Orange County. Definitely not translating. Inventory is going up here, but not at a pace anywhere close to that. So we'll dive into that here in just a moment. But we went from 637,991 homes to 640,221. So up, about 4,000 homes, just less than 4,000, actually less, 3,000, just over 3,000 homes nationwide last week. Again, the peak from last year sitting at 739,000. We're still below that, but plenty of time to reach it. And as time goes on, I imagine we're going to get closer if we don't pass it entirely. So Orange County, 3,123 homes on the market. That's up 1.31% week over week. Huntington Beach actually declined, down 5% week over week. So we've seen inventory grow, and then we've seen a little bit of a pullback. Again, nothing to worry about at this point. Inventory will continue growing throughout the spring, especially with rates trickling down where they are. I imagine if rates stay where they are, Josh, next week when we come on, depending on where sellers are in that process, it's going to start to unlock some inventory, in my opinion.
You think rates coming down, the sellers will be like, I will buy at that rate. So
yeah, I think so. I don't think we're at the rate yet that they're quite ready to pull the trigger. But if they see a trend happening and we don't get this volatility that we've been seeing, I think you're going, because we're headed in the spring. People are already thinking about it anyway. I think you got sellers that are willing to sacrifice that lower rate because of personal situations with their homes and just things that they've been dealing with over the last couple of years that, quite frankly, they're ready to move. They haven't been willing to pull the trigger because of rates, and they're starting to get sick of that waiting, if you will. So nationwide, single family new listings, 54,000 new listings unsold this week. That's down 3.8%. Or no, I'm sorry. That's down for the week, but 3.8% more than last year. And as we can see in the data at the moment, there's no sign yet of government cuts causing home sales in DC or anywhere for that matter. So we're not seeing a spike in properties coming to the market. People saying I got to sell my home because they got laid off with part of the Doge.
It feels like, Jeb, a lot of things in Trump world, there's a lot of dust. And then when it settles, there's not as much action as people had feared. So I'm not saying that is the situation here, but I think most folks would do well to settle back and say, let's see how it actually shakes out before saying this is going to lead to a huge surge of inventory anywhere.
Well, I also think it's a bias in people wanting to believe that is going to happen and it's going to help drive home prices down. And there's a narrative there, and we can see based on who's posting those charts on X and some of these other platforms, you know, and using data that's not quite the same as everyone else's data.
And it absolutely bears watching. I mean, it's a reasonable thesis, right?
Absolutely.
It's not some crazy tinfoil hat. Like if this happens, this should follow to some degree.
Yeah, these are government workers. These are not bottom of the. This isn't your typical recession affecting the bottom of you know, the income pool. This is people, you know, probably not, you know, more white collar workers, but kind of middle median income earners and maybe toward the higher end, but it's going to affect them. And some of these people, if they don't have the savings, that's essentially the next step, right? Is having to do something.
I saw an article comparing it. The biggest corporate layoff in U.S. history was IBM in 1993, 60,000 jobs lost. And they're saying the way this is looking, it's looking like to be at least 100,000. So they are around the country, but they are clustered in areas that are a single specific metro area that would be impacted in terms of real estate. So definitely something to watch, but we got to actually see how it plays out.
Absolutely. So this is weekly new contracts pending. 57,000 home sales started plus 12,000 condos. That's 6% fewer than last week, 5% fewer sales than the same week in 2024. But here's the kicker, Josh. Did you know that mortgage rates are now lower than they were at the same time last year?
It doesn't surprise me.
Yeah. So mortgage rates
last year was an unpleasant start to the year. Yeah.
So the question is, will that nudge, you know, more people to come to the market, both on the buy side and the sell side? And what we've seen so far, Josh, is none of this has lasted very long in either direction. So we're going to talk about that, I'm sure. So home prices, let's see, home prices inched down this week, 385,000 for the median price for newly pending contracts, which again, we don't really care so much about median, but we're putting it out there.
But Jeb, I didn't have time to pull it together. Did you see we got FHFA and Case Shiller, and they were both a good bit higher than that?
Yeah, I think it was in the fives, 4 to 5% year over year. Yeah,
high fours.
And that goes back to December, I think. This is down a tick for the week and 2.6% more than 2024. And then lastly, on these charts, price cuts, we look at them every single week. We're sitting at 33.2% of the market's homes on the market, rather, having some sort of price cut, which is, you know, kind of in the normal range at the moment. So nothing too concerning. This is, you know, one of those charts that we like to put in there. It can be a little bit difficult to read just because of how it's structured. It's hard to break it up otherwise, but basically just shows what this clearly doesn't show the 200 largest metros, but shows 41 markets that have active inventory levels at or above pre-pandemic 2019 levels. So if you go through that list, you'll notice a lot in Florida, like a lot. Texas is probably the second behind Florida, a lot of Southeast, and then you got some Colorado sprinkled in there. So that's where you see, you know, you hear people talking about inventory starting to tick back up. Those are the markets that have been impacted the most. And then we start talking about new home sales, right? So less of a concern for most people out there, but it is a hot, you know, one of those headline grabbers that, you know, new home sales are down, so on and so forth. Again, this is seasonally adjusted, but you can see that we're below where we were in 2024. 600 and something odd thousand, Josh. I don't remember the exact number on those numbers. But when you start looking at new home inventory, right? This is what they're talking about when they're talking about inventory. You can see that completed, you're still, you know, just around 100,000 or so units. And then the biggest cohort there is under construction. And then you have some that aren't started yet. So the not started is questionable, depending on the market that they're in. They may or may not come to the market, just depending on what's happening out there. But something to pay attention to, because new new home sales have been a big driver over the market over the last couple of years, just because of where rates are, their ability to buy down rates, so on and so forth. So we've seen that pull back a little bit, likely because of seasonality and some other things, but we'll continue to watch and continue to update you on that. So Josh, number of unsold completed homes for sale on the market, and this is
it's
the same chart we just looked at.
Yeah,
but
different look at the same chart. And the reason why Lance put this out this way, this came from Resi Club, is to point out that we're nowhere near where we were in 2007, 2008. People read the headline, oh my God, highest amount of homes on the market since, or construct new home inventory since 2008. But this is the important number. How many of them are actually for sale? So you can see it's definitely trending up, and it is going in that direction. But we've said before, and I say again, the builders learned their lesson. They built right through that peak in 2007 and just kept completing homes. They will start slow playing completions. It's a dance for them, because if they don't sell homes, they don't make money. But if they make so many homes that they have to sell them at a discount, they lose money. So definitely, I put this, Jeb, in that same category of, hey, we got to keep an eye on it, but it's not necessarily what the headline is saying right now. And more importantly, Jeb, this is, again, Lance just has a follow-up on this, the number of completed single-family homes by region. So if you look, that gray section is the Northeast. If you're in the Northeast and you think this has anything to do with your market or is going to lead to lower home prices, you're insane. The Midwest, not much of an issue there. West, not much of an issue. It is an issue for the South.
I have to imagine building homes, tracts of homes, not a house, tracts of homes in the Northeast has to be a complete nightmare because of the seasonality. Like it's brutal during the summer. It's, you get probably maybe 6 months a year max of like great weather, and then you still get a lot of rain. You get a lot of the seasonality in it. It's just not an ideal place to be doing new construction, just in general, at least in my eyes. Maybe builders think otherwise, but that's the way I think of it.
I thought you were going to talk about the political process in the Northeast and having to go through City Hall and building permits. And
well, I'm sure that's a piece of it. I truly don't know
involved.
all of that, but I'm sure that adds to it as well.
I just thought that was a good look. In the South, definitely a big deal. So Lance was on fire this week. They actually did a presentation, a webinar for subscribers, and had some really good charts and data in there. So I just pulled a sample of them here. Breakdown of U.S. household size. You can see there are more 1- and 2-member household sizes than there has been historically. So it's telling you that, what have we talked about before? When you have multiple people under a roof, mom and dad, 2 people, it makes it easier to qualify. Mom and dad, mom and mom, dad and dad, we're modern folks around here. It could be any people cohabiting that 2 or more people have income. It makes unaffordable homes more relatively affordable. So it's an important piece of data to keep an eye on, and just realize I don't think that's going to change, Jeb, anytime soon.
How about the 7+ person household is actually trending down? There's less of those.
Well, in the 1960s, there were the family down the street.
That's
had
fair.
Like
my grandfather was one of 12, one of 11 rather. And so, I guess at that point they had a lot of people under the house.
So I was born in the 70s. You were late 70s?
80, I was 80.
So 70s and 80s, there was always that family on the street where they had like 5 to 10 kids. So I think those folks are fewer and further between. This one, we see a lot of talk about. The U.S. Census Bureau keeps downgrading its population forecast. Absolutely true. But we're looking at this, and the green box I added on there, that's the next 30 years. So if you look, population is going to continue growing through the next 30 years. So we've underbuilt. We're not building enough homes, definitely not enough entry-level affordable homes. And this is not going to help us. It's definitely trending in the right direction.
I'll just wait 30 years to buy.
Just wait. That's what I'm saying. If you're waiting it out, don't wait it out. It's not going to help you. This is another trend just showing home builders are reacting to affordability by building smaller and smaller homes. Is this a huge difference, 2,300 square feet to 2,036 over the course of 10 years? No. And the 50s called and laughed at your idea that we're going smaller with a 2,000 square foot house when those folks were living in 800 square foot, 2-bedroom, 1-bath homes. But interesting data nonetheless. Another thing that they pointed out is just the age of the housing stock. So throughout the South, where we're saying all that newly built inventory is piling up a little bit, Well, everything in the South is much newer median age of homes. Not that there aren't old homes in the South, but median age is much lower. Northeast, Midwest, older. West Coast is a little bit different. But that tells you in terms of the inventory you're looking at. We talked about, Jeb, your home was built in the 80s. Mine was built in the 70s. Yeah. So now you're talking those things are 50 years old. So it starts telling you things that if these haven't been updated, they're going to need updating. Tells you a little bit about what you're going to be looking at when you're out in the market. This one's one of the best ones, Jeb. Here is our silver tsunami. It shows you per Freddie Mac how many additional, so the decline in boomer households. So this shows you we've got boomers going away. It doesn't show millennials and Gen Z coming behind them and filling that gap. But logic would tell you that this chart here is telling you we've got plenty of them to fill the gap, especially millennials. I think was a bigger generation than Gen Z. You young folks watching can correct me if I'm wrong. Some basic info here. Consumer sentiment. One of the reasons why we've seen a decrease in rates is consumer sentiment is definitely downshifting. We had a pop back there around election time when some people, felt more strongly, positively about the economy going forward, but it is a concern. This tells a different story here, Jeb. U.S. corporate yield spreads. So treasury bonds are issued by the U.S. government. It's the safest investment anyone can make in the world. Well, loaning to corporations, they can go bankrupt, they can go out of business, far more risky. So what we typically see is a nice big spread between those two. And that spread right now is the lowest that it's been in many years, which tells you that investors are getting complacent, just like they're paying more and more for stocks. And we see the stocks at elevated levels and seeing a little bit of a correction. We could easily see that in corporate bonds as well, which again, these are just not, I wouldn't say red flags, warning signs. They're a little bit of something to pay attention to. So as we look, Jeb, what happened? This is again the last 5 days in mortgage bonds. Mortgage bonds, we want to see the prices go up because when the prices go up, the yield or the interest rate that you pay goes down. This was almost over the last 5 days, exactly 100 basis points improvement. That's about 1/4% interest rate. So we can check our work here. Here's the 10-year treasury, again, from 4.5 and change a week ago to 4.26, almost exactly 1/4% better in interest rate. Here's the chart with the candlesticks that we normally show you. We are entering in an important point. So we're at the bottom of this down channel, and those channels generally tend to stay intact more than they tend to break. So the most likely next move would be back to the top of this channel. Doesn't mean that we would lose the downtrend in interest rates, but you also see that pink line there is the 200-day moving average. So all of those things are coming together to tell us there's some resistance here. If we break through it, it's going to tell you there's probably some strength behind this movement lower in interest rates. But we have some questions, Jeb, already in here. Hey, if I missed this and I locked and rates have gone down, can I renegotiate? Do I float? What do I do?
We'll talk about them. Yeah.
This tells you there's some caution to be had there, even though we've seen that nice improvement. The only really important data we get the rest of the week, Jeb, is PCE. January of last year of 2024 will fall off. It was 0.4. The forecasts here per the nowcast from what is it? Is it Cleveland Fed that does this? They're projecting that we're going to be right there over 0.35. That would round up to a 0.4. I've seen several forecasts expecting a 0.3. If we get a 0.3, we're going to see some improvement. You're going to see headlines saying, hey, PCE inflation is good. Not much chance of a beat to the high side in terms of hot inflation, but it's either going to help or it's just going to be relatively flat. This again shows you, we can check here and just show you about 1/4% across the board better in the last week in interest rates.
And if you're somebody out there watching, guys, I know there's people out there that have interest rates. You watch the show to see where rates are. If you have a rate higher than the rate that you want and you're looking to refinance as rates go down, get on the rate watch. I think there's, what do we say, Josh? 100 and I don't know what the number was. It was over 100
a lot.
people.
And Cassim was going through it today. There's a lot in there. And for those of you that are on it, we're getting ready to do an update. I don't know if Jeb's going to participate, but I'll do a short video, a couple of these charts, and just let you know kind of where we're at, because all of you on that list, I mean, there's some fairly high interest rates and there's some fairly low interest rates that are quite a ways from triggering. But a lot of you, I think, probably should at least look at the numbers so we can determine what that strike rate is. Because, Jeb, I don't know about you, we've had so much volatility. The thing that the last 2-3 years has taught me, don't take anything for granted. Just because rates dropped 1/4% in the last week, you don't go, oh, now we're in this downtrend. and then you miss that opportunity to lock at a low interest rate.
And we're going to talk about that. So it's jebsmith.net/rate watch. We'll get you on that list. There's nothing you need to do other than fill out some information, provide a little bit of documentation, and then you're on that list until forever, really. I know some people have asked that. So we are going to basically do, or Josh, rather, I'm not doing anything. Josh is going to do the heavy lifting on that in order to just to make sure you're taken care of as rates start to trend down. So with that said, Josh, let's start it off by talking about rates a little bit, in the sense that rates hit their lowest level last year in 2024 in September-ish area, month rather. A lot of people thought at that point rates, that was going to be the trend. Rates were going to continue lower, and people hesitated and didn't do anything, whether it was locking a loan for refinancing, purchasing, whatever. And a lot of these people got burned because not only did rates shoot up, they shot up fast. I mean, we lost a 0.5 point in a matter of days to some degree. And so a lot of people got stuck, you know, not being able to continue the refinance. So what I would tell you is, if the process makes sense, don't pay a bunch of points to refinance your loan. Don't pay a bunch of costs to refinance your loan. Don't buy down your rate to refinance your loan. And there are circumstances, situations where it makes sense. For most people, it does not. If rates are trending downward, if that's the direction you believe they are, take advantage of them as they come available. Again, without paying a bunch of points. Maybe you take a slightly higher interest rate than you would than the best rate in the market, so that you can get a credit from the lender to cover the cost. So that there's no money out of pocket. You're not adding it back to your loan balance, and you're being able to take advantage of the market as those opportunities become available. Because otherwise, you sit there and wait, and then it ticks up, and you go, well, crap, I wish I would have known it would have ticked up. I would have just done it. That's the problem. Josh doesn't know when it's going to tick up. I don't know when it's going to tick up. We think we know the market to some degree, but at the same time, it's irrational. Some of this thinking is irrational thinking, and it doesn't make sense. So my preaching, my soapbox moment here is to tell you to take advantage of it as the opportunity presents itself.
And even right now, Jeb, so we're going to end up recording tomorrow. We wanted another day of prep, but for next week's podcast episode, we're going to be talking about this and what has led to the lower interest rates, and what was the most common theme that you and I saw from experts that we follow. They're like, we're not sure. Here's 3, 4, 5 reasons that could be leading to this improvement. Probably the best hypothesis that's been thrown out there is David Rosenberg says this is not a repricing of lower inflation. So real rates, the real return is decreasing based off of the belief that the economy is actually slowing for a number of reasons, which we'll go into on the podcast, but not here. So if that's the correct hypothesis, that we're moving to a slower economy, lower growth, possibly recession, it is deflationary. So you get the deflationary piece with it eventually as well. But yeah, it's going to be interesting. I don't feel super solid right now. And probably the most important thing to underscore what Jeb said, Bence here says he was burnt in September, and you are not alone, my friend. Probably half of the people on that list thought that rates were going to go lower and didn't reach out in time, or until rates had already turned back around.
All right. So here's what we're going to do. We're going to answer some questions for you guys, because that's why you're here. But we got Darren watching in Illinois, Julie in Western North Carolina, miscellaneous of the whatever from Vegas, Dave C from Oregon, Katie from Oregon. And Katie came to the show early and started posting some questions in here. It really has to do with a certain program, Josh, FHA, that allows, that provides up to a $13,000 credit. I'm assuming it's a credit, $13K if you install solar. And I'm assuming it's added on. I don't know if these sometimes these programs are local, Josh, right? They're not nationwide programs. They're regional stuff. But to clarify, she's looking to put 3.5% down. So between upfront mortgage insurance, minimum down, and solar, we would be upside down for a bit. What are your thoughts on something like this?
So it basically says here, it provides $13,000 if you install solar. If it's just a way of financing it onto the home, because if you're worried about being upside down, it sounds like it's not a credit. They're just going to help you finance it all into the same purchase. So if it's an FHA loan, depending on who has that second loan, like here in California, Cal HFA will do assistance, and they'll do it as a second and sometimes a third mortgage behind your property. and they will tell you to pound sand. If rates drop 2% in 6 months and you want to do a streamline, they're going to say, cool, pay us off because we're not going to subordinate that. So you need the appreciation to happen. My big question is, like, go to, I think Google calls it Google sunroof. Go plug in the numbers. I would be shocked and amazed if solar in any way makes sense in Oregon. And I know Oregon's different, just like Washington. You know, Western Oregon is going to be grayer than Eastern Oregon, which can be a lot more like desert. So it's possible. It's possible you could be somewhere. I would just be really careful with solar. You know, I've always kind of been of the mind, Jeb, that at some point it's going to make sense for everyone, and we get so good and so cheap that we'll all just have it no matter where you are. But it hasn't really gotten cheaper. It's gotten more expensive. And we're seeing now with the big AI data centers that big tech is getting behind small modular reactors for nuclear. And if we end up with that, you're going to look up and go, holy geez, I'm still paying off this, you know, $25,000, $35,000, $40,000 solar install. You know, Jeb, we got another listener here that they're out. We got them pre-approved. They're out looking at a home here in Yucaipa where it's very hot, makes all the sense in the world to have solar. And someone had an $80,000 solar installation, which the house they're leaving had a $35,000 or $40,000 solar installation, a very similar sized home. He's like, how did this person get taken this badly? So I digress a little from this, but I don't know that specific program. I did a little Googling while Jeb was doing the open, and I couldn't find anything on it.
All right, good stuff. Burn it up says, hi, gents. Hope all is well. So regular viewer there. So thanks for being in here, Burn. We got some. So Dave C. Is 80% loan to value cash out refi the new norm? I can't seem to find a lender for 90% or 100% LTV cash out refi. So Josh, is that
only if we consider the last decade or so new? Just like you're saying, 100% LTV cash out refi. Since the meltdown, we haven't had 100% cash out or 100% purchases. So they're certainly not going to go back and say, hey, we made you put a down payment, but we'll let you take all of the equity out. So we had higher LTV on FHA about 4 or 5 years ago. FHA was the last holdout to kind of come in line at 80%. So from that perspective, any of the major programs, 80% is going to be your max. And you will notice on conventional, anything over 75, the pricing is pretty aggressively bad. So unless you really, really need the money, there are other programs, non-QM stuff that'll go to a 90. If you have good credit, we can look at seconds that can get you there. So there's ways of doing it, but yeah, no, 90 and 100 have been gone for a long, long, long time.
All right. I feel like John Doe's talking to the 8th grade Jeb here. And when he said,
do we have the picture? Have we ever shared the picture, Jeb?
Oh, we did at one point.
We should do it
have
again.
The photo. I will bring it next week. I've just got to remind to put it in here. It says my stepdad hired some realtor out in Southern California. I wasn't in Southern California. I was in Eastern North Carolina at the time. But it says guy showed up to the inspection with a fat herringbone. Dude, I loved a fat herringbone. Like in the mid, well, it was probably early 90s, dude. I mean, I'll show you the picture. I had a little, like barely like the little
stash,
beach fuzz mustache and a herringbone. Oh, bro.
Is Landon getting ready to grow the stash?
Hide your wives.
Are you going to get Landon a herringbone once it grows in?
You know, my kids have that Irish skin of their mothers. I don't know that they're going to have any facial hair. We'll see. We'll see if it comes in. I don't know. But anyhow. Let's see. Miscellaneous of the whatever. Is getting an appraisal the only way to remove PMI in refinancing on a relatively new mortgage? So, Josh, you have to get an appraisal.
You're going to have to show the value. They're never just going to take your word for it. And, hey, trust me, my house is worth this. Someone else followed up here in the comments. I literally just had another listener, Ramin, sent something in. He sent the paperwork from his servicer that told him exactly what he needed to do. They do generally offer a broker price opinion, which maybe, Jeb, you can tell them what a broker price opinion is. It is a cheaper option, but I don't know. What is it, and what are your feelings on a BPO relative to an appraisal if you were trying to get rid of MI?
So a BPO is a broker price opinion, which essentially is going out to the market. Sometimes they have these people, I wouldn't say contracted. They're not contracted, but they've agreed to do one of these price opinions, maybe for $20, $25 in some cases, whatever. With essentially somebody like me, doing my version of an appraisal, going out, getting comps, and coming back with what I think the value is, and doing the same thing appraisers do. You're deducting for things that are different in the comps you're using. You're adding value in certain ways, so on and so forth. So we had to do a lot of them back in the REO days when we would receive a foreclosed property. We had to provide what we thought the value of that home was to the bank, like an appraiser. So unfortunately, we had to do these, and we had to do them often, and it's a lot of work. But if it's an option for you, it's probably a much cheaper option. So you might explore that before going the other direction.
It was like $150 versus $350 with Ramin Servicer.
So it's definitely worth considering. We got a couple others watching. I'm not even going to try that one. From Georgia, noon. I mean,
it's a silent G. It's got to be
noon or none. Yeah, I don't know. We got Inglewood. Inglewood's in the house.
Was just in Inglewood last week. We saw a concert at the Forum on Friday night. It was good.
I was up there showing property recently, so I've gotten to see a lot of Inglewood. Musica says, what is the best place to check current rates in my state or county? So John, vary by county. They don't vary by state. Interest rates are a nationwide thing. So regardless of where you are in the country, the rate shouldn't change based on your location. But with that, Josh, where would someone go to check interest rates just in general with an accurate way? Because you can go to these news sites and it's all advertisements, and basically it's pay for click type stuff. So
yeah, it's pay per click. It's the biggest liar is listed at the top. So you don't want to go to any of the rate tables. Do not click on them. Please don't put in any of your information. Your name will be sold 9,000 times and your phone will blow up. The two that we like, and the one we rely most here on the show is Mortgage News Daily. So if you go to Mortgage News Daily, a VA, 30-year, 15-year jumbo loan, and it's going to get you a very good estimation of where you're at. You can also go to the Optimal Blue Mortgage Market Index. Optimal Blue is actually a system that about 60% of lenders in the United States use to price and lock their loans and run their secondary marketing desks. So they're extracting data like the ADP jobs report that comes out every month. It's real payroll data that goes through the system. Well, Optimal Blue, it is real lock information that goes through their system, not someone putting something up online to get you to call and then do a little switch on you. So either one of those are very good.
I appreciate that. Good stuff. Good stuff. Let's see. Brett says, when you make an offer on a house, how much time should you give before the offer expires? So different states, I assume, approach this differently. California does it, which is the only one I can really comment on because I don't know the other contracts. Is the way the contract's written is it's 3 days. So the contract, your offer is good for 3 days unless you change it. Oftentimes sellers will change it and they'll say, hey, you know what? I want an answer immediately. I'm offering, I know they want to do open houses this weekend, but I'm going to make an offer today and I'm going to give them 24 hours to respond. Well, what happens is, in theory, if that seller doesn't respond within 24 hours, then your offer is no longer valid. And most buyers, at least in my experience, are willing to even accept it if the buyer or if the seller were to come back 2 days later and counter or accept the offer, what have you. So I would say don't get too crazy on making expirations unless it's truly a line in the sand for you. If it's a line in the sand and you're going to walk away, then by all means do it. But if you're not serious, don't put it out there, because at the end of the day, it kind of makes you look not serious. It doesn't make your negotiation look very strong when you've drawn a line in the sand and now you're coming back on it. So just understand the seller's timelines, try to work with them as much as possible, but be flexible. But when you no longer want to be flexible, put that line in the sand. But to answer your question, I don't know. It's whatever days you want. So if you want to give it more time, you can. Less time, it's up to you. Josh, are townhomes a good investment for a starter home?
So we went through this a couple of weeks ago in the idea that for most of the country, townhome is just a style of condo. It's the style, like a condominium can look like an apartment building and be legally a condo. When it's a townhome, it's generally stacked multiple stories where you own the first and the second floor, first, second, third floor. But in certain parts of the country, there are properties legally described as a townhome. So for me, I look at them similarly to condos. Most parts of the country, people have a preference for detached homes, but detached homes are more expensive. So you can have affordability improvements. You can have less maintenance. So a lot of times people prefer these. Hey, I travel a lot with work, or whatever it may be, and prefer that. So from an investment perspective, like the only thing I look at is attached properties generally appreciate later in the cycle and depreciate first in any downturn. But for the most part, over the long haul, they're going to appreciate very similarly to a single family home. What are your thoughts, Jeb?
My problem, my problems with properties essentially kind of come down to the same thing. As long as there's parking, like when I think of townhomes, I think of how much yard do I have? If I don't have a yard, how much common area do you have? If you have kids, if you have pets, that sort of thing. Also have to think of resale value. It's not buying a townhome that's necessarily an issue. It's buying a townhome that's in a bad location, or that it has potential issues that could um, limit the number of buyers that would be interested in that property. I can think of some complexes here in Huntington Beach, no parking. It's a nightmare. You got to move jockey cars in order to make things happen. The walls are thin. You can hear people. That's not every property. That's not all townhomes. That's just certain communities. For me, that wouldn't be my first preference. But I think when you're starting out, you have to, if it's the right time in your life and you want to own something, then you have to go with where your budget allows you to do. And a lot of times condos and townhomes fit that, fit that more than anything else. So I don't think there's anything wrong with it.
My first home, Jeb, was a townhome that was, it was legally a condo, but townhouse style condo. And we enjoyed it.
No, I don't think there's anything wrong with them at all. But to each his own, right? They're not for everyone. SF Miners, if I lock my rate before the interest rates dropped, is there anything I can do to get the new lower interest rate, Josh?
Depending on how much lower they are than when you locked, and this gets a little bit technical in terms of how to explain it, it's going to need to be more than an eighth. So let's say at least 1/4% lower in interest rate. If rates dropped an eighth, basically the lender's going to look at you and say, hey, if rates had gone up 2%, we were going to eat that or cover it with our hedging. And so we expect you to honor it if it's within an eighth. Once we get to 1/4 or more, they will start looking at this going, hey, it's enough of a difference that we're going to lose some loans that were otherwise going to come to us. So they'll have a renegotiation policy. So for the most part, that is not, hey, we're going to give you the new market interest rate. It's going to give you the new market interest rate, less a little bit of a cost to acknowledge that you were locked and protected against the other side, and there was a hedging cost to them to do that. So kind of the example that I give is if rates drop 1/4%, that means there was 100 basis point movement in mortgage bonds. And what most of the lenders will do is say, hey, you met the threshold to do it, so we'll give you the 1/4 lower, and it's going to be like a 50 basis point cost. They're going to give you half of that cost. So you're only going to realize about 1/8% improvement. Now, if rates moved 0.5% from the time that you locked, that's like a 200 basis point movement. So again, they're not going to say, we're going to charge you half of that. We're going to say, we want about a 50 basis point cost for that. So you're going to get about a 3/8 improvement. So you're going to get all but about 1/8% of the improvement, 0.125%, and rates probably have to move at least 1/4%. Talk to your lender about it and ask what that policy is.
All right. We have Steve says, looking at a 2-bedroom, 2-bath with 2 attached ADU. So I don't know, maybe a 2-bedroom attached ADU. Not sure. Either way, garage is not permitted. How will the value be assessed? Will VA approve the property? So, Josh, you know more about VA than I do in this situation. Typically with an unpermitted addition, oftentimes it's how an appraiser looks at it, right? So the appraiser typically won't give that value. So if there's a sunroom or something on the back of a property that's been added in, they just don't give that sunroom any value, and they're just appraising the main structure of the house, right? And in that case, sometimes it still comes in at value. Many times it does, because, if I were listing something with an unpermitted addition, I wouldn't be counting that square footage into my numbers. So I'm already factoring that in. Some people aren't. But Josh, how does VA look at it? Because there's an appraisal specific to VA that's a little bit more stringent in this sort of thing.
So it's it's a myth that it's more stringent. They do have to look at it a little bit differently. There's a couple of pieces to that. So if it's gross living area, meaning that we're talking about living space, the garage is not gross living area. If it's gross living area, it has to have been done in a workmanlike manner. It has to meet the neighborhood. It has to be similar to the neighborhood where they can get comparable sales that have similar additions. So if we're talking a basic addition, probably the big one is it has to have a heating source. It can't be like an enclosed sunroom that doesn't have heating. So from that perspective, that's what they're looking at. The VA has their own thing called minimum property requirements. And basically it's health and safety, again, for the veteran to make sure that your family is not going to be at risk being in that home. So if it meets the MPRs, it's conforming to the neighborhood, it was done in a workmanlike manner, and it can be comped out. Similarly, you can use that. With conventional, we don't really have a problem with it either. You may run into an issue with FHA, but if it's something where you walk in and you go, oh, this is a funky, weird addition, you may have problems with it. If you walk in and someone has to point out to you, hey, that master bedroom off the back of the house wasn't permitted, but you looked at it and it was awesome, it's probably going to be okay. The garage is a horse of a different color, just because it's not gross living area. I've seen janky garages before, so I would go back and say, is it presenting a health and safety issue? Is it consistent with what the rest of the neighborhood looks like? And generally, a garage isn't going to be make or break on the value. It's not going to be something that's going to keep you from buying the home. It could impact the value.
All right. Josh, where do you think prices will be next year? Are you willing to make a bet?
Well, look at everyone's numbers.
Or a gamble.
We showed the big wide spread, anywhere from down 5% to up 12% was the 30 or 40 experts that Resi Club polled. And most of them fall in that 3 to 5%. And I think positive 3 to 5% appreciation. So 3 to 5% appreciation. And I think it could be anywhere from 1 to 5%, depending on where interest rates go. If interest rates are in the low 6s most of the year, it's going to be higher near that 5%. If interest rates are up near 7 or over 7, you're going to see 0 to 1%. So I don't see nationwide a drop just because of supply and demand dynamics. But it's weird that Jeb, we kind of have this give and take, is that things that are bad for the economy would generally be bad for real estate, but it's good for interest rates. And a lot of the people that got priced out, if the economy gets bad enough and they feel secure enough in their job and they've saved up their down payment, maybe they'll jump in. So I feel like there's sort of a floor underneath us and then a ceiling up top based off of those higher interest rates if the economy remains strong.
I don't disagree. I agree with everything you said there. I think if I remember my forecast, a month and a half ago was somewhere between 3 and 5%. That's kind of where I think the market's headed. Raul says, for a beginner real estate investor, should I look for a cash flow property or a property I know that is going to appreciate a lot within a few years and get the equity, but it's not cash flowing basically on a monthly basis? So Josh, one of our friends says,
what's our friend say? I was going to ask you, what does our friend say? Yeah.
No alligators. Basically it means you don't want to have a property that you're throwing cash at every single month, right? That's kind of the bottom line. When becoming an investor, you have really two options. You could go cash flow or you can go appreciation. And sometimes you can get both by doing short-term rentals, but it's risky because you just don't know what's going to happen with codes counties changing, codes changing, all of that good stuff. So I would say cash flow property is the better for a real estate investor, at least to get your feet wet. You start understanding the process. You understand how to, put money aside for different things that might go wrong in the property, how to deal with tenants, all of that. And as you get more accustomed to that, if you want to start going more for appreciation, you can do it. But I think a good place to start is cash flow. Josh, we had a question here for Mr. Josh, somebody that is Katie. It's Katie again. Katie is the commenter of the night. Katie says, watched an older video from Josh's channel and a guest mentioned comparing no or low point interest rates and rates offering lender credits for higher rates. How do you advise clients to compare? So Josh, I think we're talking about maybe a par rate and a rate that's slightly higher and getting a credit to cover costs, kind of where we started the show.
As part of that pre-approval process, the lender that you're working with should be doing that with you and for you. The thing that shocks me, Jeb, when we do second opinions, people say, hey, I'm looking to refinance. I got these 5 loan estimates. What do you think about them? The thing that's shocking is that all of them have a great interest rate with just a horrific amount of points, whether it's 1 point, 2 point, 3 points. Like when we're talking to a borrower, you always start the conversation at 0 points, because that tells you what is the market interest rate. I'm not paying to get it lower. I'm not asking for a lender credit. So usually, good example, we have a listener in Michigan, sent out some numbers to him earlier. He doesn't know exactly where he's going to end up, 500 or 550, 600, 650. But I said, I'm going to send you 0 point options on all of these. Once you kind of look and see where you're comfortable with in terms of the purchase price, now we can go, instead of 3 different price point options, now let's look at 0 points, 1 point, 2 points, or you may say, hey, I don't want to pay for the closing costs. Give me a 1 point lender credit, 0 points, and then a 1 point me paying that. So that way you can see the change to the monthly payment, the change to the cash to close, and calculate a break even really easily. Like at the end of the day, most people that you guys are talking to about mortgages, they're not mortgage advisors. They're mortgage salespeople. They want to tell you, hey, we've got this great rate. Don't look over there. Don't look at those points. Don't look at the cash to close. It all comes into play. You have to balance that. You all want a low payment. Low payment means a low interest rate, but lower interest rates generally mean more cash to close. So it's going through that and finding the right balance for you of getting a low rate and payment without taking all of the money you have in the bank.
All right. Mr. Zen Scripts says, what just happened? Why did the 10-year just shoot up? So the 10-year didn't shoot up. The 10-year shot down. Mortgage bonds or mortgage-backed securities shot up, I guess, if you will. So, Josh, can you explain? You did a little bit to begin with, consumer confidence. Why are we seeing the 10-year react the way that it has?
We've seen some good reports, and we always talk about this. Good reports for the economy would be hot. Things are firing on all cylinders. We had that hot CPI report a couple of weeks back. The day after that, we had PPI. PPI, several of those components go directly into the PCE report that we're going to see on Friday. So those numbers were tame. It's leading people to think that we're going to have a under control PCE number on Friday. We had a very weak retail sales report after that. We're finally seeing spending down among high wage earners. They've been the ones doing all the spending and supporting the economy, and we're finally seeing that starting to break. We've seen the stock market roll over the last few weeks. Now, we've seen this 3 or 4 times over the last couple of years, Jeb. We see a 10, 20% correction and then back off to the races. So we'll see. Tomorrow will be interesting, Jeb, because NVIDIA was after hours, right? Came out and said, we're still selling tons of chips. So it'll be interesting to see if that puts some wind back in the sales of the stock market tomorrow and would pull some money out of bonds and make things get a little bit worse. But those are all of the hypotheses that are floating around as to why we've seen a 50 basis point improvement over the last 6 weeks in the 10-year yield.
What's NVIDIA doing after hours? I forgot they reported today.
I didn't look. I just saw the headline that they
down like 1%. So
the market didn't beat by enough.
Yeah, well, we'll see what happens. I mean, it's obviously, we'll see in the morning. Anyway, Jake coming in with a question about DTI. We don't get a lot of questions on DTI, but this is your debt to income. This is how a lender verifies how much home you can actually afford, right? Because they have limits on how much debt versus your income you can actually have. But he's asking, what's a good general rule of thumb adjusted for 2025? And he's laughing. People are spending more and more on their mortgage year over year. So we know our good friend, Mr. Dave Ramsey, wants us to spend no more than 25% of our take-home pay
net income
of our take-home pay on a 15-year fixed mortgage. That's not realistic for most people. The other rule of thumb out there, Josh, is this 28 over 36. It's kind of been the golden rule, if you will, when it comes to mortgages, so that you can't spend more than 28% of your gross monthly income towards a housing payment, toward housing expenses. And that gives you about 8% or so if you're at the max towards debts on top of that, Josh. But you obviously see a lot higher. Is there a good rule of thumb for everyone?
To me, this relates back to people who say, okay, cool, I need to get you my numbers. I need to get pre-approved. You need to tell me what I can afford. I cannot tell you what you can afford. I can tell you what you can qualify for. The qualifying guidelines have not changed at all. So, Jake, you are not wrong. We have the data. ICE puts it out every month in their mortgage market monitor of what the average DTI is, and it has absolutely been creeping up because between higher home prices and higher interest rates, those payments went up rather quickly. But from that perspective, it's what you are comfortable with. Jeb mentioned 28 over 36. When I started doing this way back in the 90s, there was no automated underwriting. So that was it, 28 over 36. You might get a 38 if you had, wonderful compensating factors. My buddy and I found one of our investors that had this unique program that would allow you to go all the way to a 40. We're like, this is amazing.
Woo.
We got a conventional loan that will go all the way to a 40. So everyone at that point, you go to 41 on FHA. So if you were over 36, it was pretty much hard and fast. But over 36 DTI, you're going FHA. So is there a number? Is there something magic out there? I don't think so. I think it comes back to what's your comfort level. Where are you comfortable? That number is higher. If I ran an analysis on our loan origination software of closed loans over the last 3 years, I can tell you it continues to trend up.
Sure.
But you saw the thing, home builders are building smaller homes. Median home price is not going up at the same rate as what you see when we're looking at repeat sales index like Case-Shiller or FHFA. That's because when the same house sells over and over again, it's going up at a certain rate, but the median price point is not going up as high because people are trading down. They're getting less home than what they wanted before. So it's a combination of that, taking on a higher DTI than what they would have hoped and getting a little bit less home than what they would have hoped. It's compromise is what we're seeing from buyers in the market right now for most of them.
All right, good stuff. Newbie Life, pre-approved, but has funds in crypto, and they aren't seasoned. So seasoned, just for those of you watching who aren't familiar, basically means it's been in an account, been able to document it for at least 2 months. But the question says, will the underwriter give a conditional approval, Josh? This is new construction. Closing date is in June. So between now and June, do you have enough time to season those funds?
They should absolutely be able to give you a conditional approval. It's conditional upon saying, and it's not, we can show the crypto for the most part. I mean, if you have it in a cold wallet and it's sitting out there and we can't tie it back to you and it's going to pop into Coinbase and then pop over to Chase, we could have some issues there. But if we have that timeline, the loan can literally be conditional on, hey, you need $42,000 to close and we've got $14,000 of seasoned funds. We need $28,000 sourced and seasoned funds. And that way the loan officer and hey, we're approved, but it is conditional upon this happening. This question, Jeb, reminds me of one that I get a lot. I get people that call from the show, call from your channel, and they want to talk and say, okay, we're talking to this guy. He's going to get us fully underwritten. Like, okay, well, tell me about your situation. Okay, both you and your wife are salaried borrowers. You got 800 credit scores. All your money is sitting in the bank. Why are we going to underwriting? Like, there's what we generally find is loan officers that are either pitching this hard. It's one of two. Either they're inexperienced and don't have the confidence level to make that decision and tell you with 100% certainty you're pre-approved up front, or they're with high cost direct lenders that what they want to do is get you convinced, hey, we went through this underwriting process. You have a bird in the hand, a certain thing. So for someone who is well qualified, who doesn't have a lot of moving parts that we're worried about, it is pretty rare. If I send a file to underwriting while you are out shopping for a home, it's because we got questions. We got questions in how we're going to analyze the income. Does the underwriter agree with us? Is there something funky on the credit that we're not sure about? So it wasn't an answer to the question, but it's something that comes up a lot when you guys call in.
All right, Josh, we got about 5 minutes or so left, and let me be a little bit more, but we get a lot of questions. So let's rapid fire some of this stuff. We got a question that says, should I pay down on my principal now if I want to streamline refinance in the future? So Josh, is there any benefit to paying down a mortgage before you refinance? Can it be done through the refinance? What are your thoughts?
Well, the fact that he's asking about a streamline is interesting and unique because the value doesn't matter. The loan to value doesn't matter. So there's not going to be any benefit to paying down the loan. So from that perspective, you don't have to, but I'm assuming you're doing this for yourself. You're wanting to get the principal paid down, and that's going to happen, and you'll have a smaller loan when you do that streamline. So I guess I almost look at this the inverse way. Is there any reason not to prepay principal if you're hoping to streamline? And I don't think so. If that's what you want to do, continue doing it.
Good stuff. Rahul coming in with another question tonight says, where can I get the information about the zoning of my city? So zoning in your city is going to change depending on the parcel, right? Every city has multiple types of zoning. What I would say is find a good agent in your market, and they can connect with a title rep or be able to look on tax records, that we have access to that tells you zoning for specific areas. But within a certain area, you can have multiple types of zoning. You can have R1 for basically residential one. You can have R2, sometimes R2 to R4, whatever. So it's not just for zoning for the city or the area. It's complex. So you're going to need to know more specifics in order to get more accurate information on that. Mike says, do you think mortgage rates will continue to go down tomorrow? So Josh, I'm not sure that. Here's what I think. I'm not saying go down or go up tomorrow. When you see the move that we've had over the last 2 days, for it to continue, you need a push. In my opinion, you need some data backing it up. I just don't think you'll see a big drop in that. But that's my thought. But Josh, my chart actually shows that popping out the bottom on my side, but I know we're
either way,
a little bit different.
If you draw it that way and you're out the bottom, you still have that 200-day moving average. So kind of in support of what Jeb just said, we just had 1, 2, 3, 4, 5, 6 straight days of almost straight down, and we're hitting the 200-day moving average. We don't have anything important tomorrow. We get the weekly jobless claims and continuing claims. It could, if it really shocked of a spike in claims, it could impact it. But I get super cautious when we've got multiple technical levels there sort of converging at one spot.
Good stuff. Josh, will there be any future timeline you see where we can take our low mortgage interest rate to a new mortgage? I don't see a world in which that happens, but
yeah,
lenders make money by doing new loans.
And the banking lobby is one of the strongest in the country, and it would require government regulations changing to make it possible.
Yeah, there's no reason for them to want to do that, I guess is the better kind of thought behind it. Like, what would be the push to do that?
In most places, Jeb, around the world that do have portable mortgages have adjustable interest rates. So from that perspective, the bank goes, cool, you want to take the money over there? I don't want you to pay it off because I'm going to get whatever the market rate is, regardless of where you take it.
Yeah, so I don't see that happening. Young, could money from grants like the Ladder Up program be used as cash for keys for a multifamily unit? So I'm not 100% sure on what you mean on cash for keys. Like, you could get somebody to move out of the property or sell the property by offering them money. Is that what we're asking with the cash for keys? Because if that's the case, no. Ladder Up program, specifically, the money can be used towards down payment. It can be used towards closing costs. It can be used to buy down the interest rate. It can be used towards the buyer's agent's compensation. Those are things that you can use that money for. You're not going to be able to use it to get a person out of a foreclosed property and buy it. That's not what the money was intended for. So hopefully that's helpful, and hopefully that was your question. Josh, does your investments count for the 12 months of mortgage payments for an approval?
Well, the question behind the question is, why do you need 12 months of mortgage payments? Some loans require reserves, but 12 months, I don't know of a loan that, I mean, there's probably some jumbo programs out there that are very restrictive and they want that. But generally it's like 2 months PITI. And most importantly, for conventional loans, it's kind of fallen back to the automated underwriting system determines it and tells you how much money we need to have in reserves.
All right, good stuff, Josh. So we kind of summed that one up quick. Craig Lee says, should you buy now or should you wait, Josh?
You should buy when it's the right time in your life.
When should you wait?
When it is the wrong time in your life.
That's profound. Literally, if you're asking that question, you're probably not ready to buy a home. I can tell you, I never ask anybody that question when I was ready to buy a home. It wasn't, should I buy now or should I wait? It was, hey, talking to my family, does this make sense? Do we have the money for, in savings, for a down payment, for closing costs, for, emergency fund in case something goes wrong? Those are the things you think about when buying a house. It isn't about picking the top or the bottom. It's really about, you doing it for you. And also having somewhat of a long, some sort of time horizon in the future. If you're thinking you're going to be in that property for 1 or 2 years and sell and move on to the next one, then it's probably not the right time. It's when you're ready to build a foundation, be in a property for an extended period of time. That's when it's the right time to focus on it. Mike says, that's good information. Thinks I have until March 8th, to get a float down. Should I lock in now or wait? So Josh, March 8th, what's that? A week and a half?
The 3rd is Monday, 4, 5, 6, 7. So it's like through next Friday.
Okay.
you've had a you it's sort of like being at the craps table and you're like, I've got every number covered and I've got lots of money out there and almost anything that hits, I'm getting paid. But then it just takes one bad roll of the dice and then you've got no money. So if you're sitting and
I've had that bad roll many
I've had
times.
that bad roll. 3 a.m., too many gin and tonics, and we won't talk about 20-year-old Josh in Vegas. But anyways, it just you've had a nice run. So locked in at 6.99. If they're offering you something reasonable where the market is, I would strongly consider it. And that's not to say if you're listening here going, oh my God, they're saying locked that the market's going to turn around. No, I just feel like we've had a nice improvement, and you don't generally get a straight line like that. That being said, we could get a really tame PCE reading on Friday and be at 4.0 on the 30-year.
Here's the deal. I don't want to see big moves down like that, because big moves down like that mean the potential for big moves up can follow it. I like a little bouncing around and a gradual push down, just like home prices. Like, you don't want to see 20%, 10% appreciation year over year, because again, what that leads to, crazy volatility in the market. So you just need less craziness, more foundational stuff out there. And that's when markets tend to do their best. So, and not to say that I don't want to see lower rates, because I do. I just don't want to see it in a straight shot, because that puts more risk into the market.
That's what we had in July and August, Jeb. We were like, we said multiple times on the show, like, the market has gotten ahead of itself. We are where we should have been 3 months ahead of time. And maybe if we had had a slower glide down to that same endpoint, we wouldn't have shot back up as much as we did.
Agreed. We came in and just says, wonder what the reason for mortgage rates to drop. We go back to the beginning of the show. We've covered it a couple times throughout. If you missed that, there's some good information at the beginning, just talking about why we've seen the dip that we have and what you're likely to see going forward. We got some love from Jake saying good points. And with that, if you need to speak with Josh and the team, you're going through the mortgage process. That's not what I was putting up there, but we'll go with that. If you need to get a lower rate, you have a rate now. JebSmith.net/rate watch. You can scan that QR code if you got your mobile handy. Otherwise, what I would say is, if you need to speak with Josh, and get a second quote, get an opinion, go through the pre-approval process. JebSmith.net/start will get you in touch with the team. Josh can have that conversation. If you need to be connected to a realtor, would love the opportunity to do that. If you're here in Orange County, LA County, San Diego County, just local, need an expert, my team and I would love to help. So reach out, let us be of assistance to you, please. That's why we do this. But until next time, make sure you're buying right, borrowing smart, building wealth. Adios.
Amigos.